Um, Welcome, everybody. Welcome to our first of our BCR webinar interviews. And I'm delighted for this first webinar to welcome Peter Mulroy, who's Secretary General of FCI. He's, I'm sure, well known to most of you. Peter, welcome. Delighted to have you here, and thank you for your time. Peter, FCI has supported the World Factoring Yearbook for many years, and we're very grateful for that. And you have written the introduction in the last few years, and we are just about to publish our 25th anniversary edition in the next day or two. So I thought it was very appropriate to have you here, particularly in the current circumstances when the world and the industry is so worried about what's going on. This is an unprecedented situation for the factoring industry and the whole world, of course. And people are understandably worried about the future and what the future holds within the factoring industry. We've already seen last year the biggest drop in volume ever recorded within the factoring industry. And in our yearbook, virtually every country article leads with the damaging effect that it's had on their particular market. And as I said, heads of factors are very worried. And of course, no one has a crystal ball. You don't have a crystal ball, but I think your views will be well received. You're very well respected in the sector, and there are not many people really that has a real global view of the factoring industry.
Yeah.
So let's start by talking about the expected surge in factoring when we come out of this current situation. Now, in your introduction, you used a phrase that you were expecting a rather explosive 2021. And I know that view is to some extent based on past crises. But if we have a look at what happened in the last banking crisis, for example, the situation seems to be quite different in many ways. For example, we've seen a lot of government support in many markets. We didn't have that last time. Our IT, what we have in terms of IT support generally is much more advanced than even 10, 12 years ago.
Very true.
We've seen a huge demand for communication systems like Zoom and like Teams, like we're using now, which we didn't have before. And also the state of the banks, the health of the banks is very different. The banks are much healthier now than they were coming out of the last crisis.
Very true.
And also things like credit insurance position is quite different. So tell me, Peter, what are you basing your views on in terms of your expected explosive growth, as you put it, coming out of this?
Thank you, Michael. And well, first off, just want to say, FCI is delighted to be another sponsor of the World Factoring Yearbook again, and it's always an honor to participate in it. We view it as always an important instrument for the community, the factoring community, to know what's happening across the world in a detailed basis. But I said in the introduction that I find this one to be probably one of the more important because it is going to be a record, in a sense, of the severity of the worst crisis that has ever hit the factoring industry in the last 50 years. And I you kind of introduced it by saying, we had a big decrease this year. But of course, we had a decline in 2009, to your point, as well. But the difference is that if you look at the actual value of the decline in 2009 versus 2020, the decline was 6 times worse than it was in 2009. So you can't compare the two crises. This one has been extremely more challenging. The financial crisis was a financial crisis, and it didn't have the same kind of ripple effect in Main Street as it had in Wall Street. And this was just the opposite. You had, in a sense, the Main Street that was severely affected, but it didn't affect to the degree Wall Street. Wall Street globally, I'm using that as a reference to all markets, financial markets globally. It just didn't have the same impact, especially related to banks. And to your point, I think because banks were much more prepared for this crisis, and in great part due to the Basel Accords and the strengthening of bank balance sheets and increases in capital and all the Basel positive effects it has had on strengthening of the financial sector. So I think overall it's been this crisis is so completely different in every aspect. Okay, that being said, I just to your question, I do believe that this surge is here to stay, and I base it on a number of factors. One, you're seeing
Sorry, Peter.
yes.
When you say it's here to stay, we are currently seeing a surge already.
We are seeing a surge already. Yes, we're seeing a surge. I'm hearing it from all corners of the world. I have to say the surge is more contained in the developed markets in comparison to the developing markets because of the uneven distribution of the vaccine. The vaccine being much more readily available in the developed markets, and as a result, you're seeing the economies opening up. You're seeing retail fully open. You're seeing restaurants back open. I mean, the whole national economies are back in the developed markets. But in the developing markets, South Asia, for example, Bangladesh, parts of India, Pakistan, I mean, these guys are going through major upheaval still. So it's very uneven. But
Sure.
okay, the largest economies are doing well, and there are reasons for it. Of course, I think a lot of people were worried about the effects of the slowdown in the stimulus, but the stimulus has continued. I mean, look at the U.S. We just had two major stimulus injections in the first quarter. They're now talking about a third stimulus relating to the infrastructure program that I believe will pass, and that will be probably start sometime in the second half of the year or first quarter next year. And it keeps going, and that's in Europe as well. The monetary easing is still extremely prevalent, even though with fears of inflation. So these are all having really positive stimulant effects, and
Sure, and in fact, you mentioned it in your introduction that the first half of this year has been seen a volume growth spurt.
yes.
But how sustainable do you think this is likely to be? And as you say, it depends on which market we're talking about. But try and give us a sort of global picture if you can.
Well, you said it earlier. The first reason why I say it is because I have history on my side. I have known facts relating to the growth of factoring after every financial crisis. And after every major financial crisis, the industry has exploded nearly double digit over a decade, both after the Depression in the US, after the Great Recession, 9% growth. So we have the history be on our side, number one, and that's probably the most important.
Okay.
The second, though, yeah, go ahead, please.
I was going to move on to the next question, but carry on if you've got more to say, Peter.
No, I'm just, plus you have the kind of other stimulants. You have inflation. Inflation is in essence a great thing for the factoring industry because it inflates the value of the invoices. So I highly expect you'll see average invoice sizes in the factoring industry increase. It has to, with all raw material inputs going into it, commodities, soft or hard commodities, labor costs are increasing, transportation costs are increasing. So all this is going to spell positive just unto its own relating to the average invoice size within our industry. We're seeing existing sales of clients exploding. We're seeing record new business numbers coming in because a lot of SMEs have been pushed out during the crisis, or they feared that they were being pushed out, so they looked for alternative sources of liquidity. And so I'm hearing across the board that there is a record increase in new business development, which means future sales embedded. Cross-border.
Do you see a larger take-up among larger companies? There's been a bit of a trend in that in the last decade or so.
I can't tell you this year, but what I can tell you is I'm hearing that we are seeing a surge in non-notification factoring, and typically where you see a surge in non-notification factoring, it's typically tethered to large corporate, because it's a large seller still selling to a large buyer, and they want to do it on a confidential basis. And I heard from a number of factors that there's a significant rise in undisclosed factoring. And the other, Michael, is cross-border. Cross-border is growing double-digit around the world. So I think all these things really bode well, to be frank.
Yeah. Yeah, in fact, we've moved into my next question, and you've already answered it to some extent. International factoring, you said, seen significant increases there. Invoice discounting, significant increases, non-notification. How about reverse and differences between recourse and non-recourse?
Well, reverse is one of these fascinating stories because during the crisis, well, during 0809, we saw a huge decline in reverse factoring volumes, and one of my predictions was we would see that again, because banks typically retrench, and some of these larger investment rated companies, yeah, they may have strong balance sheets, but you saw a devastating effect on their top line due to the closure of economies. So I was expecting it to slow, but I was wrong. And I was wrong. I was partially wrong, I would say. And what was different with this crisis is that COVID forced people to the largest retailers. So the distribution of street retailers, non-e retailers, and other distributors, they lost business to the these large mega retailers, the big box retailers, as we call it.
Because mega retailers probably already had established online channels
Well,
as well
that,
as.
but also one-stop shopping. People didn't want to go and go to 10. They had their mask. They wanted to go one place and shop and get everything done. And we saw that in the figures as well with reverse factoring. We saw a significant surge, for example, in the United States, because these large programs are targeted to companies like Target and Walmart and other large mega box retailers. So, and it was the same with Europe with Carrefour and other major retailers that all have supply chain programs. So, but in our statistics, what's really interesting, we don't capture a lot of that data, but we do capture, for example, the entire reverse factoring market in Spain, the confirming market. And what we saw there is a 40+% decrease. And why is that? Because Spain is one of the most entrenched reverse factoring markets in the world. And they have, meaning they have drilled down to non-investment rated buyers. They're not just doing the large investment rated. They've drilled down. They're also financing many more SMEs. And so as a result, these programs were cut, higher risk. SMEs were obviously hurting due to the COVID crisis, so lack of volume. So it was so we see different stories coming out of this reverse world. It wasn't all roses and yes.
Sure. Actually, you mentioned risk there, Peter, and I wanted to talk to you about that because, okay, generally speaking, we're expecting and currently seeing very large volume increases, and we think that's going to continue. But what about the situation with regard to risk? Because, as we know, companies coming out of a recession can experience overtrading and severe cash flow problems. And, we are, as we saw in the last crisis coming out, the risk profile had increased. And I think I'm right in saying that there was an increased amount of fraud taking place. So how concerned should we be about this?
No, I totally agree with you. And of course, when I hear words of increases in non-notification factoring, for example, in a very, very volatile market, I get scared. I mean, because what is the one common denominator we've seen over the last 20 years in our industry is that the vast majority of frauds happen when banks or financial institutions that offer factoring loosen their standards and provide predominantly non-notification factoring.
And those will be the big ones as well.
And they will be the big ones. So honestly, it worries me. I think, I mean, the one great thing, the strongest factoring communities in the world, I trust them, meaning I trust their systems, their capability, their management. So I they generally know what they're doing, but it's maybe the more companies more in the emerging markets, if they start loosening standards and they don't have the sophistication, they don't have the history, the credit culture. Yeah, I worry. I would say also, you know, I worry about, for example, we saw last year a huge increase in retail bankruptcies in North America, and the factoring industry got extremely impacted, adversely impacted. Um, I don't think we're seeing that now. I think I did a quick check just to see, and although bankruptcies are flat in the U.S. Uh, and I haven't seen any brand names or big major retail bankruptcies to the degree, of course, that we saw almost every week during the COVID crisis last year. We saw some in Europe, Germany, UK, Italy, France. Uh, but I do worry with the withdrawal, for example, of these credit insurance shields in Europe. Uh,
Right.
what's going to happen? I'm hearing that lines are being cut because
Mm.
now these credit insurers are standing alone. They don't have government support. So
Yeah, and of
I
course
worry.
this was a huge problem in the last
Yeah.
crisis with credit insurance cover being unavailable to so many markets.
Yeah, and of course, yeah, they stepped away, and so the big question mark is I'm not worried about 2021, but I am concerned about 2022.
Mm.
Once things really start to close up in terms of stimulus, there are supposedly these zombie companies out there that have been just basically propped up by
Yeah.
government assistance,
Hmm.
and what's going to happen when that assistance stops. And so that leads to, for example, as well, issues of fraud, to your point.
Mm.
And always when we see a cyclical environment like this, of course, you have a higher propensity of companies defrauding factoring companies.
Yeah.
So
Yeah.
I
Okay.
think it's I think we're okay until the next 6 months. I don't see anything really I don't hear from the members anything on the horizon that really overtly concerns them,
Mm.
um,
Okay.
because of all the capital in the market, because of
Yeah.
quantitative easing, because of the spurt, the growth in. I think maybe the non-bank financial institutions, so the smaller ones, will have a harder time in this environment.
Well, actually,
Yeah,
Peter, I wanted to ask you about that, and specifically fintechs, because the growth in fintechs came out of the banking crisis 12
yeah,
years ago. And at that time, as fintech started to develop and grow and make an impact, a lot of traditional operators, factors, were saying that fintechs didn't really have enough experience of the market, and they were expecting during a second crisis, which we're seeing now, they were expecting um, a lot of fintechs to struggle and perhaps not survive. Do you think that's happening, or do you think we might see that?
oh, well, I mean, of course, if you go back to my May article, which was published by FCI in the newsletter, I made 10 predictions, and one of them was that we would see a significant deterioration in the credit quality of fintechs. I was pretty certain about that, and I haven't seen the degree of numbers of fintechs filing bankruptcy or defaulting, closing their operations. Although there have been a number of funds that have been severely affected, like Greensill. There was an organization called Barak Fund in Africa that were funding receivables, that were funding, and especially non-bank financial institutions. This is a concern of mine. I mean, picture this. I mean, 0809, we had what, 1.3 trillion euros in volume. And you could estimate that approximately 1% or less of that volume was funded by kind of all these alternative sources, hedge funds, family offices, pension funds, etc. Uh, we've tripled the industry in that time, and you see the likes of a Greensill and the role that Credit Suisse played in distribution of capital to these companies that were financed by Greensill, and the destructive aspect of when a fund doesn't know what they're doing in our business, and it
Sure.
really, to me, put put a fear, I think, in investors and in these smaller companies, and a fear in multiple ways. A fear of the unknown because
Mm,
of what happened, but also a fear that for the first time these funds could become regulated. And
mm,
that is a fear because family offices are not regulated today.
sure.
They can spend freely, invest freely,
Mm,
and so I think this whole case is really broad. And look at what's happening in the next 10 years. We're at around 3.3 trillion today in factored volume, US dollars. If you add reverse factoring, securitizations, asset-based lending, maybe we're over 5 trillion.
yeah.
And if we grow at a lesser rate, like let's say 6% compared to like the 9% we've been growing, that means we'll hit 10 trillion by 2030. We'll go
Mm,
from 5 to 10 trillion. That's 10% of global GDP. If you estimate it at around 100 trillion, which we do, uh, uh, how is that going to get funded? I mean, is that all going to be bank funded? Absolutely not. So
mm,
the trajectory of these funds are going to play a more and more important role, and especially both because banks don't want to hold assets in their balance sheet.
yeah.
So they need to divest. They
Mm,
need to find investors,
yeah.
and
Sure.
also and non-banks.
Yeah.
Sorry.
And if you put Greensill to one side, I mean, certainly after the last crisis, there was an increased focus on the receivables and asset class. I think investors were beginning to take much more notice because they saw the stability in
They
the
saw the
receivable.
stability and they saw the history of very limited losses. You know,
Yeah.
if you compare the receivables finance industry to commercial lending, we did a study. It's almost 5 times less in comparison to. So I mean, the writing is on the wall, but if it's not done properly, and we always say, you know, in our world, because we're dealing with invoices, because we're dealing with dilution risk, we're dealing
Mm,
with fraud risk. You have to have your hands inside the car engine. And as soon as you take your hands outside and you just expect the car to go, of course,
mm,
and if you're funding
mm,
kind of blindly, like Credit Suisse was doing, relying on a credit insurer that no one ever heard of,
yeah.
these are things that are going to be of extreme concern for the industry in the future. And I think it was all a great learning lesson for us. It was actually very
Mm.
positive to me.
Sure. And of course, the
Yeah,
whole investigation of that is still ongoing, and we're yet to see the final, you
yes,
know, results of deliberations on exactly what happened there.
absolutely.
Peter, we're almost out of time, but I'd like to end with uh, your thoughts and advice in terms of what can FCI do to help and support the industry through these coming months and even
Yeah,
years. Maybe we're not in as bad a position as we were
yeah,
10 years ago, 12 years ago, coming out of the
true.
banking crisis, but certainly there will be challenges ahead, and certainly there will be there'll be a lot of differences in the way the market is performing and operating, and the way practitioners will be performing and operating. So, what advice can you give to the factoring community out there, and what's kind of support can FCI give to the factoring community?
Well, I always say a factor can be defrauded at any time by anyone, and we know that frauds in factoring occur, especially during times of crisis like these. So, my first point is to the entire community: guard up and prepare yourselves to be defrauded, because this is when This is when it happens. This is when cash flow concerns come up. This is when you have invoices that are either falsified, enhanced in their value, issued early, so fake future invoices that we saw in the Greensill case.
Yeah, fresh
So
air.
these are things that are happening now. They could be happening in your back office right now. So
Yeah.
this is the first thing I would say: back to basics in this crisis period. Back to basics. And what does that mean? I mean, to me, that means ensuring that you're following best practices as the industry teaches, as FCI teaches, and either pony up on your knowledge of fraud prevention, which FCI has courses in, client selection and control, underwriting procedures, et cetera, et cetera. So That would be
Yeah.
the most important thing I could
Yeah.
say today is prepare yourselves for
Mm.
a challenging period.
Yeah.
Even though
And
even though the sun is rising, I do see choppy waters ahead.
yeah, yeah. Watch out for the clouds. Yeah.
Yeah.
Try and dodge them. Peter, many thanks indeed. The yearbook will be out in the next few days, as I mentioned. Back to basics. Let's leave on that point, because that was certainly a point you mentioned in the introduction. And thank you very much for joining us today, Peter. Thank you very much.
Pleasure. Thank you so much, Michael.
Take care.
Thank you. Take care. Bye-bye.